is Avijit Chatterjee, recording a weekly session of Chartsarefun. This is for the week of January 12th, recording this on the evening of January 18th. Today, we will talk about some contrarian signs on the market. There is overall huge bullish sentiments about the market in 2026. There was a Yahoo Finance article saying almost every bank in Wall Street is bullish on the market this year in 2026. So we will share some, as we do in our channel, we often talk about technical signals, and we'll share some technical signals that are worth considering in terms of potential chances of 2022 kind of a cyclical bear market repeating in 2026. We'll show some similarities, again, yet to be confirmed till the market does pull back, but early signs of a potential repeat of 2022 seems very likely. With that, straight into our Substack site, chartsarefun.substack.com. We appreciate you subscribing to it through email, and the blogs will be sent to you as soon as they get published in the mornings. Our YouTube site is also at Chartsarefun. Appreciate you subscribing to the channel, and then if you like the videos, if you could hit the like button. So this is the article I'm talking about. It was from a Bloomberg post in Yahoo Finance. Pretty much every Wall Street analyst is now predicting a stock rally in 2026. The biggest target for 2026 S&P 500 is 8100 by Oppenheimer, and then the lowest is by Savita Subramanian in Bank of America at 7100. All higher than where S&P closed in 2025, around 6,900. So first thing I'd like to do is a technical chart that we have shared in the past, but this is more from a macroeconomy, looking at the linkages of unemployment, looking at the linkages of the yield curve steepening to the S&P 500. So this is a 50-year chart of S&P 500 on the second panel, the unemployment rate mapped on the top panel, and then below it is the yield curve as measured by long-term rates subtracting the short-term rates from it. So in this case, the long-term we're measuring by the 10-year US Treasury yield, and the short-term in this case is the 2-year US Treasury yield. So subtracting the 2-year from the 10-year, that's where the yield curve steepening is. And these vertical purple lines are the times when the yield curve from the negative region inverts and then starts steepening from zero, starts going positive. If you see the last three key periods where the yield curve steepened a lot, like from zero going all the way up to 250 basis points, one was in 1990, then into 2001 around the dot-com collapse, and then the financial collapse from the housing market in 2007, we can see these three steepenings. In each of these instances, we can see that the unemployment, which is in the top panel, climbed. So in this 1990, it didn't climb as much as it climbed in the 2007 financial crisis. But in each and every instance, when you see these vertical purple lines, there is an unemployment creeping higher in those periods when the yield curve steepened. So we are currently in the most recent cycle of yield curve steepening. We came from a negative yield curve for most of 2022 through 2024. And then from late 2024, we crossed that zero line in the yield curve, as in the 10-year minus the 2-year, and that since then has crept higher from 0 to 0.63. We still got more room to the upside to climb, and with that we can see that the unemployment has been climbing. It has come up from like below 4% to now 4.4. The most recent month of employment data, the non-farm payroll employment data that came out for December, unemployment came down from 4.6 to 4.4. But we do know that employment is a lagging indicator, and if the economy starts slowing, which we can start seeing some cracks. There are situations where the consumer is in heavy debt, credit card debts are kind of shooting higher. There is tremendous amount of unpaid balances and so on. And if the employers start clamping down on hiring, we know that this unemployment rate can start creeping higher, like what has happened in the past periods. So that's something for us to watch. But key is the yield curve steepening, which primarily in this case is the 10-year minus the 2-year. So if you look at the 10-year, and the other key thing is in each of these instances, you'll notice that there has been a market pullback. So when the unemployment creeps higher, when the yield curve steepens, market pulls back. There were deeper pullbacks in the dot-com collapse from 2000 to 2002, in the 2007 to 2009 bottom. Those were deeper collapses. The COVID one we are ignoring. That was kind of an outlier because of the pandemic. The entire world shut down for a few months till the COVID vaccines came out and the world came back. But in the drops there for the COVID, if you take that out, in every other instance, except in 1990, where the drop was not bad, it was 22% drop in S&P 500, but then from there it started climbing to a mega bull cycle, and that was primarily the internet kind of a boom, causing the big kind of a growth and climb. In this particular case, we got to watch and see what's happening. We did get a pullback of about 20% or so in the early 2025 from the tariff-related jitters and fears from February of 2025 through April. We did get a 22% pullback, but from there we've been climbing higher highs, and that's something for us to see that usually the pullbacks don't necessarily come right after the steepening starts. It comes a little later. In this case, you can see that it's sometimes few months later. So it's possible that we could be in this case maybe a year later or a couple of years later after the steepening, we could still get a pullback because unemployment has not really shot up like we have seen in the past. So until unemployment starts steadily going higher, showing weakening of the economy, and yield curve really starts picking up from the 0.63 towards the 200 basis point or higher, is what we got to watch. Now, the 10-year yield in particular is flashing a warning sign. This is the chart of the 10-year yield, and what we can see is what happened in 2021 was an inverse head and shoulder with the slanted neckline happen, and then a breakout, and yield curve 10-year yield shot up. So all of 2022, as the 10-year yield shot up, the market pulled back, and that's something that we are watching very closely because that trend line that it broke in 2021, we have a similar kind of a trend line break to the upside shaping up. So right here we can see a slanted trend line joining the peaks from 4.8 in early 2025 to 4.6 around April. And then we from testing a lower low from 3.98 to 3.95, we are now creeping higher. And last week, because of the jitteriness of President Trump saying that he's probably considering Kevin Warsh, Kevin Hassett as the Fed chief, market thinks that Kevin Warsh is going to be more aligned with what the president wants and so on. So the independence of the Fed is being putting the market into quite a bit of a worry, and that decision or any other economic kind of instabilities could cause this 10-year yield to break higher. So we did get some upside. So we can see here 0.71. This is a daily chart. So we basically went up from 4.16 to 4.23. So basically 7 basis points climb in a single day just because of President Trump making some indications that he's probably not going to be considering Kevin Hassett and more looking at the Kevin Warsh as his Fed pick. Now, that break higher will not be bullish for the market. And then if you look at some early warning signs of a momentum ETF called PTF, it's an Invesco Momentum Technology Momentum. These are looking at the NASDAQ stocks and picking the 30 high momentum stocks in it. And we can see a similar repeat of what happened in 2021 before the big collapse came, with 2 successive peaks with lower highs in RSI. This is how negative divergence happens before topping, and then we get the breakdown. A very similar looking pattern is shaping up where RSI is at a lower high, negative divergence like in 2021, higher highs in that PTF, RSI at lower highs, and now getting ready if we do get a sharp pullback. Now, the typical pullback gets towards the 50 period moving average. In this case, from 61, we got a sharp pullback to 34. In this case, from 84, we are looking at a pullback down to 54, which is where the 50 period moving average is right now. So that's almost a 30-point move with 84 to 30, and having a 30-point move right there. That's closer to, almost 33% or so kind of a drop to get there. So that's something quite a sharp drop can be expected. If you look at the core components of that ETF, PTF, these are all similarly weighted. It's not that they're heavily weighted to the large market cap stocks like the QQQ is or S&P 500 is. In this case, NVIDIA is one of the holdings at 5.5. Ondas, which is a defense supplier, they make a lot of the high-end technologies for kind of drones and other kinds of intercepting warfare kind of technologies. They're big into sensors, they're big into making electronic kind of components, and that has been on a fire, but 5.5%. Apple is their third holding, KLAC 10 core. The KLAC is kind of a big supplier to chip manufacturers. So when TSMC had huge earnings in last week on Thursday, that primarily indicated significant capex spending, and their capex spending, which is the chip manufacturer of the largest chip manufacturer in the world of AI, TSMC, means the KLA Siten Corp and LRCS Lam Research and ST Microelectronics, all these directly get benefits of that spending. So those are technologies or beneficiaries of that chip related capex. And then the memory space and the storage stocks, the Western Digitals, the Seagate Technologies, Micron, have been on an absolute climb. And a lot of this is powered by the AI momentum of huge memory demand on these data center buildouts with AI chips and AI systems. And those are driving kind of a huge demand as a result, supply constraints on these memory chips. And as a result, those stocks have been on fire as well. So if you kind of look at the relative comparison since June, we can see that Ondas by far had almost 727% growth over from June till like we're talking about last 7 months till January to date. And that's almost 8x kind of growth in Ondas. After that, the next biggest is what we see here is from 727%, around 326% is Western Digital, which also has had an astonishing climb, 4.2x kind of a climb. And others are all very strong, except the two bottommost is Apple, which are really because of the laws of the sizes. These are huge trillion, $3-4 trillion stocks. So Apple and Nvidia in this case are the lowest in terms of the percentage gainer since June, 35% on Nvidia. But if you think about their sizes at 4 trillion and more, 35% is not a joke in terms of market cap gains they've had in a span of 7 months. So Nvidia at 35% and Apple at 26% is the kind of growth they've had. But that overall indicates extreme euphoria. But in this euphoria, don't forget the key chart pattern that the higher high here is repeated with a lower high in RSI, indications of a topping pattern. So got to be extremely careful in chasing these momentum stocks. Another key thing to point out is if we look at the 10-minute chart of QQQ, which is the NASDAQ 100 ETF, we can see when it gaps higher in the morning, 2 successive days it did that. Throughout the day, selling happens and it closed a lot lower from where it gaps up in the morning. So there is distribution going on during the day with smart money exiting technology stocks. As a result, those gap ups are sold into the day, closing towards the lows of the day. Both days, successive days, Thursday and Friday, it happened. And similar kind of day happened on Tuesday as well. Gapped higher, touched a new peak, 629, and then selling throughout the day, closing towards the lows of the day. And then Wednesday, it was pretty much selling throughout the day, and it kept, from its open, it was selling throughout the day, keeping the QQQ towards the lows of the day. So that's something that we need to be very cautious about. But if we look at a key signal, which is another repeat of the 2021 going into 22 happening, is as the QQQ, in this case, NASDAQ 100 index is called NDX, which is the same as QQQ. QQQ is the ETF for that index. So NDX, as it climbed higher highs in 2021, look at what the bullish percent, which is the bullish breadth of that market. Those 100 stocks, look at the bullish breadth of that. The BPNDX, the NASDAQ 100 bullish percent, has been printing lower highs, and we can draw a line through the highs, and we can see that printing trend of lower highs followed with an eventual break from that rising trend line, and then NDX kind of crept lower through all of 2022. An identical pattern is shaping up. As we are getting higher highs in that NDX, look at what's happening to BPNDX. Exactly like in 2021, printing lower highs. This is another classic warning sign that markets breadth, the bullish breadth, this is with the percent of stocks in the NASDAQ 100 that have bullish charts, bullish point and figure charts, is printing lower highs. It's not going as high as it did since that May timeframe. From 85, the most recent high was in the low 60s, and now we are at 50, about to go below 50. And then guess what happened in all of 2022's bear market pullback? We got a sharp pullback in NDX, and this BPNDX went to single digits at 7. A repeat of that is possible. The last we saw of single digits was in April when the tariff-related pullback happened. Another repeat of going to the single digits of the bullish percent of NDX is very much possible very close to breaking this rising trend line, joining the lows like we did here in 2021. A big warning sign. If this break happens, which could happen any day now, we could expect to see much lower markets shaping up in the near future. S&P 500 versus the QQQ is another ratio to watch, because S&P 500 is a more broadened kind of index, versus QQQ being the technology heavy index. When we get a market pullback like what happened in 2022, look at that ratio, how the ratio starts climbing. S&P starts outperforming the QQQ, and that is shaping up here as well. Notice that in late 2021, we had already broken higher, pullback to test that declining line, and then from there climbing. An identical pattern is shaped up. We broke higher in the November into December timeframe, pull back to test it from below, and now we've begun to about to break higher. That break higher, that climb of the S&P outperforming NASDAQ 100 is another warning sign to be very careful, indicating potentially weakness in the technology-heavy indexes, and that's been driving the market higher. A lot of the S&P's gains have been from those mega cap, call it the Magnificent Seven stocks, all AI-related, big momentum climbs, and their weaknesses can indicate the S&P to outperform QQQ. Doesn't mean the S&P has to go up. S&P could come down with QQQ, but S&P would come down less than the QQQ, and that, as a result, the ratio would start climbing. Something for us to be very careful about. Another key indicator of market playing defense or getting ready to play defense is the Staples, consumer staples sector ETF called XLP, doing a ratio of that to the technology ETF called XLK. These are both spider ETFs, XLP being the staples and K being the technology. Look at what happened in 2021 into 22. When that ratio broke higher, the staples started outperforming the technology, and that meant market posturing into a defensive mode. Staples are defensive stocks. Market players move into it when they feel that there's going to be a market correction. They play to rotate into staples. As a result, similar situation. Look at the breakout. Similar breakout happened very recently into December, pull back to test that line from below, and now beginning to climb. That break higher, thrice it has been testing that 0.56 level. That break higher could mean similar to what we saw in 2022, staples beginning to outperform rest of the 2026, and a similar kind of cyclical bear market in 2026, like in 2022 is what we could be shaping up for. So those are the warning signs, and I would like to end with where the market is today in terms of, if we see the small caps, which we know has been doing outstandingly well in 2026, look at 2 successive weeks of sharp climbs with decent volume. That measured target from an inverse head and shoulder on the small cap ETF IWM is, look at the left shoulder at 211, back to 228, the head at 170, back to 225, right shoulder matching the left shoulder at 211, and then breakout. That inverse head and shoulder from 170 to 225, you're talking about $55 as the depth of that head from the shoulder or the neckline. So that neckline to head being 55, add to the 225 to the neckline, that measures 280. We've come pretty close. The highs of last week was 267. So you're talking about 13 more points, which easily could come in another 5% in the next couple of weeks or so. So that's what we are watching. The target on this is almost met, and that could mean that small caps would then start also pulling back quite sharply. Look at how far it has diverged from its rising moving averages from the 50, and in this particular case, the 200. That's a big divergence from where the 200 period moving average is, indicating that the pullback chances are kind of setting up. And then the S&P 500, if you look at that as the daily chart of that, something very interesting is popping up is 69.20 to 65.20 to 69.03. So that's roughly a cup with a shallow shoulder to 67.20 and a breakout. If you do that cup and handle breakout from 65.20 to 69.03, you're talking about roughly 382 points or so. So 382 added to 69.03 measures to 72.85. So 72.85 is potentially a kind of a melt up upside if we do get some upward movement in the market with any bullish kind of news in the next, we do have earnings coming up in the next couple of weeks, any of that bullish earnings, because TSMC, we know, did provide a lot of bullish momentum to the AI stocks. So any kind of last few exhaustive moves on those AI stocks could get S&P towards that 670 to 83, but that's only like possibility. But if you do get that, something else setting up as a warning sign is look at the correlation of S&P to the VIX. When S&P and the VIX, in most cases, stays negatively correlated, and that's why it stays in the negative -1 region. Times when it begins to climb is when we got to be careful, because when it climbs up above to the positive and then pulls back, you start getting sharp pullbacks. You start getting downward movement in the market. So the last time it happened was September going into October. We saw the VIX and the S&P climb together, and then the negative correlation came back in place. Negative correlation in this particular means that the VIX climbs and the S&P comes down. So they are inversely correlated. That kind of a movement is possible. VIX, we know, recently has been climbing, but if VIX breaks above 20 and starts shooting much higher and the S&P pulls back from it, we're going to resume that negative correlation back for the S&P versus the VIX. And that's another warning sign, the fact that the correlation is hitting towards a positive. So if we do get that cup and handle from 65.20 to 69.03, measuring to 70 to 83, that would be an ideal selling opportunity for those that are still holding some longs. With that, to sum it up, we talked about a very bullish posturing in the market from the Wall Street analyst, all predicting upside in the market. Average rates of S&P 500 projected targets are 76 to 7,700, the highest being 8,100 and the lowest being 7,100. We are, on the other hand, being very, very conservative and contrarian. The technical signs are not so positive. And in particular, when we look at the 50-year chart of the yield curve steepening, every time yield curve steepening happens, we end up getting market corrections. We would have got a bit of a correction in the tariff, but that could just have been a hiccup. The main correction is yet to come, and that's what we are watching. Yield curve has not fully yet steepened out. It has just started steepening from 0 for the last 2 years or so, 2.63. But if that further steepens towards the 250 or 200 basis points like we've seen in the past, that could bring further downside in the market. And unemployment also is something we are watching. Has only crept up to 4.4, could easily cross 5, go towards the 6% like we've seen in the previous kind of yield curve steepening cycles. 10-year yield in particular is very concerning. It's on an upside breakout that could lead to that yield curve steepening, because if the 2-year, which is more with interest rates, hovers around the 3.6%, which is where the rates are right now, and the 10-year starts climbing towards 5, that steepening can very quickly, so 3.6 to 5 would itself get the yield curve, because the yield curve is 10-year minus 2-year, towards that 1.4, and further going past the 5 on the 10-year could get the yield curve even more steepening. Now, this is what happened in 2021, leading to 2022 market correction. Is we can see here that this broke out, the 10-year yield broke out above this trend line and started sharply jumping higher. We are setting up for something similar. Lower highs in the 10-year yield, 4.8 in early 25 to 4.6 to now near 4.3. But if that trend line breaks and we start climbing in 10-year yield, that's a warning sign for the market. Market won't like it. And overall, we can be setting up for a yield curve steepening and a sell-off in the next several months. Key momentum ETF called PTF looks quite bearish. We can see a classic negative divergence with lower highs in RSI, with higher highs in price. A repeat of 2021 seems to be setting up where a pullback could anyway take us down towards the test of the 50-period moving average. So we're talking about from 84 to 54, 30 points of pullback in this momentum ETF, and that could indicate like 30 to 32 to 33% kind of a pullback. The core holdings are all the mega AI related stocks, Nvidia, a defense holding in there. We know with all the geopolitical climate right now, the technology provider in the geopolitical world, ONDS, is a high momentum. These are all the top 30 NASDAQ momentum stocks. And if you look at the relative performance, all in particular, Ondas being a smaller cap stock has climbed a lot, has gone 8x. Others are like the Western Digital and the Seagates and others have also kind of more than gone 4x in the last like 7 months from June of 2025. And as these climbs have happened, QQQ more recently has begun to show distribution. Gap hires in the morning end up with much lower values during the day when smart money starts distributing into weaker hands. Gap hires in the morning means weak money comes in, chases, they get higher prices. Smart money then starts unloading their shares. And that's what we got to watch. These kinds of distribution plays when you gap hire and then sell off and close towards the lows of the day happen for 2 successive days of last Thursday and Friday, early warning signs of market beginning to have distribution, smart money beginning to exit. And there are reasons why one has to be very careful with that. If you correlate the bullish percent index printing lower highs, and then that breakdown of that declining as you start climbing higher and higher in the NDX, and you see the the trend line joining the lows and broke down from it in 2022. A similar pattern. We've been testing that trend line, right, hugging down, almost getting ready to break down, just like we broke down in 2022 from a lower high in BPNDX. Same thing, bullish percent NDX, a lower high. We're about to 50 and go lower. That means we are very, very close to a breakdown in QQQ and breakdown in the technology stocks, something to be very careful about. Almost an identical repeat of 2021 going into 22 is repeating from 2025 going into 2026. So be very careful with these warning signs that we're seeing here. So higher highs in price, but then lower highs in BP. This is classic negative divergence showing weakening momentum in these stocks. Percentage of stocks with strong charts, point and figure charts is what BP does. Bullish percent weakening as price is climbing and about to break below the trend line. S&P 500 relative to QQQ often starts outperforming when we have a market correction. Last it happened in 2026. We are setting up for something similar. We already broke below this declining trend line, broke above the declining trend line, came down and tested it, and now about to break higher. As that S&P starts outperforming NASDAQ 100, it means a big part of NASDAQ 100, the technology, these AI-related stocks, their sharper sell-off relative to S&P, which is more diversified, may not sell off as much, could cause that ratio to climb. And like in 2022, a repeat of that seems to be setting up in 2026. Another signal of the market beginning to play defense, as smart money, is the Staples relative to technology, which is XLP to XLK, broke out of the declining trend line and kind of significantly outperformed, as in Staples outperformed technology in 2022. A same thing is happening. We broke out above that trend line, tested it from below, and now we are beginning to climb. 3 successive tests of the 0.56, about to break higher. Watch out. If the Staples begin to outperform, this ratio of Staples to technology begins to outperform like in 2022, very clear indication of a market correction in 2026. And finally, near term, small caps have some upside. So we are not saying that it's fully at the top yet. Little more relative performance. We can see 2 strong weeks of outperformance of small caps, from 265 to 267 that it tested. The upside measured is from 170 to 225 is 55, added to 225 is 280. So 267 to 280 is 13 points. So 13 points out of 266 is like about 5% or so. So that's potentially the upside left in small caps, and that could easily come in the next few days. And S&P 500 would have just topped out here because we do see negative divergence in RSI, not getting any stronger negative divergence in MACD. But the fact that there is this cup and handle from 69.20 to 65.21 to 69.03 and a handle and the move, we could start seeing not the technology stocks but other stocks in S&P making the climb because of earnings. And it's possible also some of the mega cap stocks could do good in their earnings. We saw TSMC strong earnings last week. That momentum could take it very quickly from a melt up fashion towards that peak near 70 to 85 in S&P is what this cup and handle measures. At 70 to 85, if we do get there, would be a perfect point to start thinking of selling and start thinking of being very defensive in terms of the market's upward movement moving forward. With that, good luck investing, folks. Be cautious. We are seeing these contrarian signs. We want just to be cautious with the market moving forward. Thank you.